This video is going to cover the 3 biggest mistakes new traders make. Now, the majority of retail traders, that's just regular people who decide to dabble in the market as opposed to professional traders that work for investment banks or prop firms. So the majority of retail traders end up losing money and giving up on trading. Some of them do so poorly that they blow up their entire account. The money that they deposited in their brokerage account, they lose all of it. And the reason for this, I'm going to speculate, is because they make the 3 big mistakes that I'm going to talk about in the rest of this video. And each one of these mistakes highlights a principle that they're failing to grasp. So you could easily flip the title around on this video and call it the 3 principles you need to grasp in order to be a successful trader, or at least not to lose a bunch of money and blow up your account. So if you watch this video to the end, you're going to get examples of these 3 mistakes, and you're going to get an understanding of the principles that people who make these mistakes are missing. Also, these principles, I'm going to start with the most important one, or the one that I think is the most important, but one builds on the other. So if you can grasp all 3 of them, you're going to at least have a holistic understanding of the principles involved in being a successful trader. Now, understanding something in theory and actually being able to execute on it are 2 entirely different things. So don't think that this video is going to in any way ready you to go out and start trading a live account. In fact, I always like to start my videos on trading with the disclaimer: I never recommend that anybody get into live trading an account. Reason being, you're likely to lose your money, and I would never tell anybody to go out and lose their money. So you need to figure out if trading is something for you on your own. And the best way to do that, or the best way to start in doing that, is don't go out and get a live account. Go out and get a paper trading account, a simulated account where you can practice the basics of placing an order, managing a trade, testing different setups, and you can do it in a simulated account where you're still trading the market in real time, but you're trading a pretend account, so you're not actually risking any money. That's the best way to get started, in my opinion. That said, when I decided I wanted to try to do this, I decided to go right into live trading because I'm dumb. So do as I say, not as I do. I've learned from my mistakes, and I would have been much better off just starting with a paper trading account, getting a better understanding of what I was doing before I started trading with real money. So first, let's define what trading actually is. Another term for trading, and I'm specifically talking about short-term trading, so think of intraday trading, that's where you open and close a position in the same day, or swing trading, where you might hold a position for a few days or a few weeks, as opposed to long-term and diversified investing, which arguably is something different. But another term for trading is speculation. And speculation is a fancy way of saying gambling. You're basically wagering on an uncertain result. So that should tell you right there why most traders fail. For the same reason degenerate gamblers wager away their fortunes to their bookie, for the same reason people go to casinos and donate their savings to the casino. Because most people just aren't any good at gambling. That said, some people are. There are the rare cases where there's good professional gamblers. Think of somebody who knows how to count cards in blackjack. If you're good at math and you're good at counting and you understand how to look at a problem in probabilities, you're still betting on an uncertain result, but it's possible to have a slight edge. With that slight edge, your winnings outpace your losses. So you're still going to have losses. You're just going to win more with your winners to make up for it. That is, until the casino figures out what you're doing and they decide to escort you out of the building. So even though I was dumb enough to start with a live account,
I can handle things. I'm smart. Not like everybody says. Like dumb, I'm smart.
I had one thing going for me. I don't like to lose money, so I had a natural inclination to be extremely risk averse. So even though I started trading with real money, I would trade a very, very small amount where I wasn't risking much in a single trade. So while I was dumb enough to start with a live account, I was smart enough not to risk a lot of money. And that leads me into the first big mistake that traders make, and this is probably the most important one, is poor risk management. Imagine that you walk into a casino, you walk over to the roulette table, and you decide you're going to bet everything you own on black or red. Pick one. It's a coin toss. There's roughly a 50% chance of the ball landing on red, roughly a 50% chance of it landing on black. So if you do this, you're either going to have a really, really good day or the worst day of your life. Why would you ever do something so stupid? And the problem is, if you get lucky and you win the coin toss and it lands on the color that you bet on, you're going to get a rush, it's going to go to your head, and you're going to think you're a genius. So you can come back the next day and do the exact same thing, and now you have double what you had the day before. So you start seeing dollar signs, and you think you can do this again. And maybe you get lucky 2 days in a row. You think, wow, I'm the best gambler that ever was. And this is all well and good until you come back the third day and you're wrong, and now you lost everything. You lost what you started with, you lost all your gains, and you're back to zero, and you're depressed, and you go out and panhandle so that you can go down to the bar and get a drink. Now, what was the mistake that the gambler made in this scenario? It was poor risk management. If instead you would have walked in the casino, gone to the roulette table, and let's say you came into the casino with $100, but you want to stay and play a while, so you're going to bet, instead of betting all the money you got, you're going to bet $1 on red. And if you're right, well, then you won another dollar. And if you're wrong, well, you only lost $1, so you still have $99 in your pocket. And you can play that game for a long time and probably never lose any money, but you'll probably never make any money either, because it's a coin toss essentially. And the odds of you being wrong 100 times in a row are pretty slim. So how does this relate to trading? Well, new traders often risk a ridiculous amount of money on a coin toss essentially. The market does two things. It goes up or it goes down. Sometimes it seems to go sideways for a while, but eventually it's going to go up or it's going to go down unless the world ends and people stop trading. So if you just randomly took a trade, either long or short, it's got about a 50% chance of working out, all other things being equal. So let's say you have a strategy that wins 50% of the time. Well, obviously you don't want to risk a large percent of your account on one trade, because there's a 50% chance that you're going to lose and you're going to blow your whole account that way. So the principle here is good risk management. Have some idea what the win rate of your strategy is, and never risk a large amount of money on a single trade. Now, what's a large amount of money? Well, that depends on your risk tolerance and how big your account is, but a rule that you'll often see touted is never risk more than 1% of your account, or at the very most, never risk more than 2% of your account on a single trade. And if you're new to this and you've never traded in your life, well, then don't risk any money on a trade and just paper trade until you get more comfortable with what you're doing. But earlier I alluded to know the win rates of your particular trading strategy. And this is going to lead into my second big mistake that new traders make, is having no clear strategy. Having no criteria for entering a trade, having no well-defined criteria for where you put your stop loss or where you start taking profit. If you're brand new to this, you want a clear strategy. You don't want to just rely on your intuition, what you think might happen, because you don't have any intuition. If you're new to this, you haven't traded long enough, you haven't watched the market move long enough to have a gut feeling of what's going to happen next. So you want to learn and test the strategy, and preferably you want to do it in that paper trading account that I was talking about, as opposed to testing a strategy on the fly with real money. Why would you do that? That's dumb. That's like going to the casino, going to the blackjack table and deciding you're going to count cards, but then realizing you don't actually know how to count cards. You can test the strategy. You can use back testing by looking at historical data and trying to see how often your strategy would have worked out. Better solution would be to do some forward testing as well. That's your paper trading account, testing your strategy in real time and getting an idea of how often it works. There's so many strategies out there. I'm not going to try to sell you on a particular one because, spoiler alert, there is no holy grail. There is no perfect strategy that's going to win every single time. The best a strategy can do is give you a predictable win rate. If I was going to give any advice at all, it would be to pick a very simple strategy, mostly because it's the easiest to follow and implement. If you make it too complicated, you're going to have trouble following it anyway. And in my experience, really complicated trading strategies don't seem to work any better than real simple ones. In fact, one of the best YouTube traders that I know, or at least that I've encountered on YouTube, is Nick Shawn, and he has one of the simplest strategies you can imagine. He basically just just trades support and resistance levels. So if price gets to a resistance level that he likes on the chart, he'll short. If price gets to a support level on the chart that he likes, he'll buy or go long. Now, is this a guaranteed win? Of course not. It's still a 50-50 chance. Maybe that support level will hold, maybe it won't, and price will go down lower. But at least it gives you a defined risk. If you're buying at a support level, well, you know where you have to put your stop loss. It's got to be somewhere underneath that support level in case you're wrong. And because you have defined risk, well, then you can go back to our first principle and practice good risk management. And you know, once you figure out where your stop loss should be, and you should have a logical place for why you're putting your stop loss there, because it's going to invalidate your trade thesis. It's going to, if price gets to where your stop loss is, that stop loss should be at a place where the market's proved you wrong. You were wrong about what was going to happen. When you know that where that is, well, then you know how to size your trade to manage your risk. If your stop loss is 10 pips away and your risk tolerance is $100 on a trade, well, then you're going to size your position to where each pip is essentially $10. So if it gets to that stop loss, you lost $100. Which, again, going back to risk management, another mistake traders make is they're just willy-nilly in how they size a position. Maybe they're good at following the same strategy every single time, but they're just random in how they size their position. So one trade they might be risking $50, and the next day they wake up and they're feeling lucky, so they decide they're going to risk $500 on this trade. If your position size is just random and you're willy-nilly about how much risk you're taking on, well, then your results are going to be random. If on the trade that you win, you risked $50, and on the trade that you lost, you risked $500, well, your winner isn't going to offset your loser. So your best bet is to, once you have a strategy, is to risk the same amount on every trade, and it should be a small amount in relation to the overall size of your account. And the biggest mistake a lot of new traders make, one that I made, was not sticking to a strategy. You know, if you win a few trades with a strategy, you think you got the market licked, and then you have a few losers, and you think, oh well, I must be doing something wrong, and you might be doing entirely everything right as far as following that strategy, but because it's speculation, because all you're really trying to do is manage risk in a chaotic environment, a decent strategy is still going to have losers. That doesn't mean there's anything wrong with your strategy. That just means the market gods didn't favor you that day. You lost the coin toss that day. But because it didn't work, the temptation is, well, I've got to change something, and I got to, well, maybe I need to look at this indicator, and maybe I need to look at that indicator, and maybe I need to see what the cycle of the moon is in this week. And since you're constantly dabbling with your strategy, you're effectively changing it and doing a different strategy. And then when that doesn't work, you're doing something else. So one of the biggest mistakes new traders make is jumping around and not sticking to a strategy. Your best bet is to pick something simple, something that's easy to replicate, and just stick with that and don't try to overcomplicate it. I've watched a fair amount of YouTubers that make trading content, and some of them specialize in just making one strategy after the other and making videos about it, where every other day of the week they're posting a strategy or a video on this new strategy that's going to solve all your problems. If you just incorporate this indicator and follow these rules, everything will work out. And it's probably a great way to get clicks on your YouTube channel, but if you're a new trader and you're watching all of this and you're constantly rethinking what you're doing, it's probably not helping you. In fact, it's probably hurting you. So focus on something simple. Support and resistance levels, like Nick Shawn does, is probably a great place to start. I like to wait for a trend to start to develop, and then I like to buy pullbacks on that trend or sell pullbacks if it's a downtrend. And I like to do it on a 4-hour time frame. I mostly trade Forex. And the 4-hour time frame is a lot more chill, like you have time to relax and think about what's going on, because it's going to be another 4 hours before the next candle forms on the chart. So my advice to new people would be pick a strategy, pick a time frame that works for you, and try not to overcomplicate things. So to summarize, mistake number 1 is poor risk management. Mistake number 2 is no clear strategy. Mistake number 3 is failure to journal what you're doing. And this was another mistake I made early on. The first week I actually decided I was going to try my luck at day trading, I did really, really well. I made like $1,400. I think I had 2 losing trades the whole week out of maybe a dozen trades that I took. And the loser was like, one of them was like 50 cents. So it was basically like break even. And one trade I lost like $50. And the rest of them were all green. They were all winners. Some of them a few $100s. And ultimately I made about $1,400 that week. Now, what the hell was I doing that week? I don't even know because I wasn't journaling anything. I was at that time I was looking at Fibonacci's and pullbacks. I was trading mostly equities and I was looking at the hour chart. Although I was doing some stuff on the minute chart. But I really couldn't tell you exactly what I was doing because I didn't journal anything. The next week I thought, oh, this is great. I'll try to make another $1,400, and it didn't work out so well. I had some losing trades, and then I started to do more research. Try to, well, maybe I need to look at this indicator. I think I started looking at the RSI. Maybe I need to wait to only buy when it's oversold and only sell when it's overbought. Maybe I need Bollinger Bands, and before you know it, you're trying all this different stuff. You're not journaling any of it. Not only are you jumping around into different strategies, but you're not even documenting what you're doing. So if you do have some success, odds are you're not going to remember exactly what was working for you. So learn how to journal what you're doing. For me personally, I find the best way for me to journal is just to bring up my charts on my desktop and record my screen. That way I can not only visually record the chart and what I'm looking at, but I can record my audio along with it. So it's like visual notes along with audio notes to myself. That's probably the easiest way for me to do it. Then I can save the file, I could date it, and I have all these notes from days that I trade. Some people might be better at handwritten notes, handwritten journals. Some people might be better in typing up a Word document, putting your notes in there, maybe taking screenshots of your charts. Whatever your system is, just have a system and maintain it. Why do you want to do this? Because in doing so, you're gonna learn from your successes as well as your failures. When I first started learning to trade Forex, I actually did start Forex trading with a simulated account. I would test the strategy that I was working on, and I would find that it worked really, really good. I would have really, really good days with the simulated trading, maybe Monday and Tuesday, and then all of a sudden Wednesday, it's like I couldn't do anything right. And I would end up losing all the gains. These were pretend gains in my simulated account, but I would end up losing all the progress I had made from the first 2 days. Again, told me, something I learned from simulated trading. I don't have the strategy quite figured out yet, and it puzzled me for a while, but then I started to realize that the days where my strategy was working really well, the market conditions were different than the days that my strategy did horrible. So on days when the market was trending, the strategy would work great. In the days when the market was going sideways, when it was consolidating or in a range, my strategy worked terrible because my signal to get in would be right about where the support or resistance level was, and the trade would instantly go against me and I would lose almost every time. But I learned that from paying attention and looking at the charts on the days that it was working and on the charts from the days when it wasn't working. And I learned that my strategy didn't work good in ranging markets. But those are the sort of things you learn from journaling. You start to look for patterns in your winners, you start to look for patterns in your losers, and you see if you can, once you have that strategy, that simple strategy that's easy to follow, you can carefully tweak it and see if you can optimize it. Now you might be thinking, doesn't that kind of violate principle number 2, have a clear strategy, and now you're talking about tweaking it? Well, you'd be right. It does kind of sound like I'm contradicting myself, but it's a balancing act. As you study your strategy and you study how your trades have played out, you're probably going to find room for progress. There's probably little things that you could tweak to make that strategy a little bit better and improve your win rate a little bit. And in trading, that's huge. That a little bit more edge is the difference between being maybe a little bit profitable or breaking even and being really profitable at what you're doing. So if you can take let's say your strategy has about a 50% win rate, if you can get that to 60, that might not sound like much, but in trading, that's huge. That's exponential. A little bit of edge is going to go a long way if you're disciplined and you know what you're doing. All right, so now that I've wowed you with my brilliant grasp of trading, for 4 easy payments of $4.99, I could teach you my top secret ninja trading strategy for 10xing all your trades. Of course, I'm joking. I'm not selling a trading course. Pretty much everything I've learned about trading, I've learned from reading a few books, watching free content that other people put up and through experience. If you get into this, you'll find there's a lot of people selling courses, and I don't have an opinion one way or the other because I've never taken any of them. And as a general rule in life, if you can find a good mentor to learn from, that's going to get you from 0 to 60 a lot faster than just stumbling around on your own. But my suspicion is a lot of these people selling courses are just scam artists. They're going to take your money and then they're going to spoon feed you stuff that you could have learned on your own for a lot less money. My advice would just be skeptical of people. If it sounds too good to be true, it probably is. That's not to say there isn't some decent people out there in the trading education space, but my advice would just be skeptical about it. If you're a complete novice to something, well then it's going to be a lot easier for a scam artist to BS you into making it seem like he knows what he's doing. But you might want to ask yourself, if they're out selling training courses on how to trade, why are they doing that instead of just making all their money trading? I mean, obviously you want somebody who's done it before to train you, but at the same time, what's their angle in doing this? Because a lot of these people, all they do is sell courses. They don't actually make any money trading. But as a general rule, if somebody isn't willing to show you verifiable statements from their brokerage to show the trades that they've made and the money that they've made, then you should probably be skeptical as to whether or not they even know what they're doing. But anyway, that's my 3 big mistakes that new traders make, and that's the 3 principles that you'll have to master if you want to have a fighting chance at making any money at this. If you found this video entertaining or helpful, make sure to hit the like button, leave a comment in the comment section below. You've been watching the Fletch Report. If you're hearing this, it means you've made it to the end of the video. But before you click onto the next thing and continue down whatever rabbit hole you're on YouTube or Rumble, I've got a small favor to ask. If you found value in my content and you want to help the channel out, the best thing you can do is share it with somebody else that you think will find value in it. Don't forget to hit the like button, subscribe if you want to see more. Links to the channel on YouTube and Rumble will be provided below. Additionally, I'm making a Facebook page for the channel as well as a X/formerly Twitter. Feel free to follow me on those platforms as well. If you're feeling exceptionally generous, provided in the description below will be a link to Buy Me a Coffee, which is the online equivalent of a tip jar. Thanks for watching, and thanks for supporting the channel.